Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Central Garden & Pet Company quarterly report. Central Garden & Pet Company offers a wide range of products and services to the lawn and garden, as well as pet supplies markets in the United States. The company operates through two main segments, pet and garden. The pet segment provides various products for different types of pets, including dogs, cats, aquatics, small animals, reptiles, and birds. These products include toys, enclosures, habitats, bedding, food, supplements, and live fish and small animals. The company also offers products for equine and livestock, as well as animal and household health and insect control products. In addition to these pet-related products, the pet segment sells aquariums and terrariums, including fixtures and stands, water conditioners and supplements, water pumps and filters, and lighting systems and accessories. The company's pet segment also includes outdoor cushions and sells its products under several well-known brands such as Aquian, Cadet, Comfort Zone, Farnum, Four Paws, K&H Pet Products, Kady, Nylabone, and Zilla. The garden segment offers a variety of lawn and garden supplies, including grass seed, vegetable, flower and herb packet seed, wild bird feed, bird feeders, birdhouses, and other birding accessories. The company also sells fertilizers, decorative products, live plants, and weed and grass control products under the Amdro, Fairy Morse, Pennington, and Seven brands. Overall, Central Garden & Pet Company provides a comprehensive range of products and services to both pet owners and garden enthusiasts through its two main segments, pet and garden. The stock price of Central Garden & Pet Co. has shown significant volatility over the past year, with a 52-week high of $37.35 and a low of $25.97. Despite this fluctuation, the company's quarterly earnings reports have been a key factor in shaping its performance. In Cone Fiscal 2025, Central Garden & Pet reported a 3% increase in net sales and exceeded analyst estimates, leading to an 8% increase in share price. However, subsequent quarters saw declining sales, with Q2 Fiscal 2025 experiencing a 7.4% year-over-year decrease in net sales. The company's gross margin has continued to expand, reaching 34.6% in Q3 Fiscal 2025 and 30.9% in Cone Fiscal 2026. Despite some positive earnings surprises, market reactions have varied, leading to a notable range in the stock's performance over the year. One of the main reasons for the company's mixed financial results is its Cost and Simplicity program, which has led to productivity gains and improved gross margins. However, declining sales in some quarters have offset these gains, resulting in a relatively flat stock price over the past year. Central Garden & Pet Company market capitalization of $2 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Central Garden & Pet Company holds a significant advantage in their industry. Central Garden & Pet Company trades at a lower price-to-earnings ratio of 15 times and a higher price-to-book ratio of 1.45 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 56% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be summarized into several key factors. Firstly, a decrease in net sales was the most significant driver of revenue decline, resulting in a 6.3% drop from $656.4 million in 2024 to $676 and $17.4 million in 2025. This decline was attributed to various factors, including economic uncertainty and other adverse macroeconomic conditions. The company's success with its central-to-home strategy and cost and simplicity agenda also had a significant impact on revenue growth. However, this was offset by fluctuations in market prices for seeds and grains and other raw materials, which negatively affected revenue. New product introductions were another driver of revenue growth, but their impact was not as significant as the decline in net sales. In addition to these factors, consolidation trends in the retail industry and reductions in demand for certain product categories also contributed to the decline in revenue. The company's garden segment was particularly hard hit, with a 12% decrease in net sales. On the other hand, the pet segment saw a more modest decline of 2.7%. Overall, these factors highlight the complexities of driving revenue growth and the need for companies to adapt to changing market conditions. The net income and profit margins of a company underwent significant changes over the period in question. Initially, the net income decreased by 51.8% from $14,009,000 to $6,841,000. This decline was largely due to a decrease in net sales by 6%, which resulted in lower revenue for the company. Additionally, selling, general and administrative expenses increased by $6.4 million, further contributing to the decline in net income. The profit margins also experienced changes during this period. While there were discrepancies in the provided information, it is clear that the gross profit margin decreased from 29.8% to 30.9%. However, a more significant change occurred in operating income, which initially decreased but later increased by $7,746 from $16,533,000 to $24,279,000. The reasons behind these changes are multifaceted. The decrease in net sales and the increase in selling expenses were primary factors contributing to the decline in net income. However, the subsequent increase in operating income suggests that the company was able to mitigate some of these losses through improved operational efficiency or cost-cutting measures. The company's operating cash flow has been a subject of confusion due to conflicting information in its financial reports. Initially, it seemed that the company was experiencing negative operating cash flows, with losses of $70,222 and $68,832 in 2025 and 2024 respectively. However, further review reveals that this is not entirely accurate. According to another report, the company has been generating positive operating cash flows, with amounts of $49,763 and $55,436 in 2025 and 2024 respectively. Based on this information, it can be concluded that the company is indeed producing positive operating cash flow for both periods. The company's debt level and interest expenses have undergone some changes over the past year. In terms of debt level, there is no significant change observed between 2024 and 2025, with a minor increase of $1.8 million from $1,190.4 million to $1,192.2 million. This suggests that the company's long-term debt has remained relatively stable. However, looking at specific pages, we see that there is an initial increase in long-term debt by $1,821 from $1,190,271 to $1,192,092 on page 16. But this increase is not sustained, as no significant change is observed between the same periods on page 28. This inconsistency may indicate some fluctuations in the company's debt level. Regarding interest expenses, there are two different observations. On one hand, we see a minor decrease of $1,000 from $14,470 to $14,511 on page 24. On the other hand, an increase is observed from $7,730 in 2024 to $7,767 in 2025 on page 31. This discrepancy may be due to different time periods or accounting methods used for calculating interest expenses. In summary, while there are some minor fluctuations in both debt level and interest expenses, the overall trend suggests that these financial metrics have remained relatively stable over the past year. The performance of our company's segments varied significantly between 2024 and 2025. In the pet segment, we saw a relatively stable year, with only a slight decline in both net sales and operating income. This indicates that our pet-related products and services maintained their appeal to customers. On the other hand, the garden segment struggled in 2025 compared to the previous year. Not only did it experience a substantial drop in net sales, but it also incurred a significant loss of $9,679 in operating income. This decline suggests that our garden-related offerings may have fallen out of favor with consumers or faced increased competition. Management is optimistic about the company's financial prospects, citing cash generated from operations and borrowings as its primary sources of funds. They believe that these sources will be sufficient to meet working capital, capital spending, and other cash needs for at least the next 12 months. The company plans to invest $50 million in fiscal 2026 on upgrades and technology implementation, which is part of its growth strategy. In line with this strategy, management is evaluating potential acquisition candidates, which may require additional external capital if suitable opportunities arise. This suggests that the company is looking to expand through strategic acquisitions, while also investing in internal improvements to drive growth. Overall, management's comments convey a sense of confidence and ambition for the company's future prospects. The company has made significant investments in its shareholders through share buybacks. Over a 2-month period, the company purchased a total of 660,639 shares. This strategic move demonstrates the company's commitment to returning value to its investors and enhancing their equity stake. By buying back shares, the company is essentially reducing the number of outstanding shares, which can lead to an increase in earnings per share, EPS, and potentially boost investor confidence. Concerns about inventory buildup are evident in various categories. Data shows that inventory levels have increased across raw materials, finished goods, and supplies. However, there is also evidence of a decrease in inventories in some instances, with notable reductions of -113,016 and -59,356 units. Despite these fluctuations, the overall concern about inventory buildup remains a pressing issue. The fact that it is mentioned as a concern on multiple pages suggests a widespread recognition of the problem. This indicates that companies are struggling to manage their inventory effectively, leading to potential supply chain disruptions and other issues. That concludes the financial summary for Central Garden & Pet Company. Feel free to comment below, and I will be happy to answer them when possible.